So the numbers was great. I think if you look at DBS earnings, it's up 70%. These are probably growth rates that you see in a tech stock. And we think the growth rates can continue. Firstly, they exited the year with a NIM of 2.1. They are guiding at least 2.2. So there's probably more room upside in their net interest margins. And I think it's always important to remember for the banks, when you have high interest rates, what it means is that at the revenue line, you're going to get pricing power in this inflationary environment. So all of us with mortgages will realize that we're going to get higher interest mortgage payments. But on the cost side, they are virtually enjoying like zero interest loans, or you call them deposits. I think for DBS, it's probably about 400 billion. So you can just imagine the jump in margins that they get. And to make it, and better still, all this just goes straight down to the bottom line. So the outlook is still positive for the banks, especially the first half where you will still see the momentum in net interest margins.
Paul, this is JP Ong. The big thing we watch out for with regards to banks is this rising rate environment that a lot of them have actually benefited from. However, if rates rise too high or financial conditions tighten too much, you could see that start to affect an economy, which then provides headwinds for banks. Where do you think the trade-off starts to happen with this rising rate environment, where it stops benefiting banks and starts to come back as headwinds in terms of lower loan demand, perhaps lower economic growth that does impact their bottom line? Is there a particular sweet spot where the trade-off actually might happen?
The trade-off we see will be on loans growth. So that is definitely slowing. I think for this quarter's results, you saw quarter on quarter loans actually contracted, and you hardly see this for the banks. So that will be the main trade-off. And that's being pulled down, especially by the weak external environment. So there's no doubt about it. I think manufacturing is coming off. But that's after 2 years of fantastic growth for the goods sector. The other part will be wealth management. Wealth management was the other part that was weak. But we think with interest rates not stabilizing and capital markets activity maybe stabilizing, then that capital markets part of their business, which is wealth, investment banking, that could give that year-on-year bounce for next year. Provisions is not an issue. I think the domestic economy is especially robust in Singapore. I think just to give you a flavor, for jobs, there's probably like 2 vacancies for every 1 unemployed person. So the domestic economy is extremely strong. It's just the external sector that might weigh it down a little bit.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.